So I think that would be fine. I think hopefully we've got a number of people joining us today where we've done these sorts of webinars or seminars historically. We've done that places such as South Lodge. You can see from the grandiose background that I've got here, I'm doing it from the confines of my office. Hopefully it doesn't look too grey, and we can get some interesting insights out of the investment and tax webinar. So I'm joined today by David Crowther. David is a tax partner in our tax services team. My name's Roy Thompson. I head up our financial services arm of our business. And really want to talk today about, or when we were thinking about putting today together, we were thinking about the budget. The original conversation started prior to the budget at the beginning of March. And we were predicting that there was going to be quite a number of changes to legislation through the budget. We all know the pandemic has cost the country a fair few billion, and in some way that's going to need to be repaid, the budget being the first line of sight over how that might happen. In reality, the budget really was a pause for thought with the promise of future tax hikes. So there was some significant announcements, but many of them deferred until 2026. So we started to reflect on where we were with the current landscape, and what we reflect on is the fact that our financial system that we live in is particularly complicated. And what we know with the notion of the pandemic and the fact that it's going to need paying for is that over the course of the next few years, there's going to be some significant legislation change, or it's highly likely for some significant legislation change. And with that legislation change will come more complexity. So the agenda for today really to provide a bit of a backdrop on the current financial circumstances, really to ask the question, why would you consider planning your finances? And what does good planning actually look like? And yes, we're going to touch on the budget with some of the changes that have taken place. I will then hand over to David, who will talk through perhaps some key principles that sit around tax planning. As we go through, if we get any questions that come up, there should be a chat box at the bottom. And if you pop your question into the chat box, David and I will try and answer any that come through at the end of the session. Hopefully that will work well for us. So if we look at the background to the current climate, the pandemic has been very binary. I read an article in this morning's news, and it was suggesting that people under 35 have borne the brunt of the job losses. I think that's fairly well documented. But this chart shows just what that means. So this really looks at net savings for individuals in the UK. And I guess on the left, we've got individuals who we might term earn a lower salary. Despite the furlough scheme, despite the interventions that the government have put in place, those lower earners have seen a reduction in their savings over the course of the last year. More typically, these are the people who've ended up being out of work. They've relied upon their savings and the furlough benefit that they may have got. The flip side of that, and the binary element, is that those people who've remained in work and have been reasonably well paid, or high earners as the government might view them, have seen an increase in their savings balance. And it's no surprise with the restrictions that have been in place, it's been pretty challenging to spend money in certain circumstances. People haven't been away on holiday, they haven't been eating out in quite the same way. So we've seen an increase in savings. What we know from looking at this is if we were in power, if we were in government, we're going to have to look to rectify that over the course of the next few years. It is going to be what we might traditionally see as the higher earners who are going to have to put back into the system to help those lower earners. So quite binary from that perspective. The huge levels of government borrowing and spending really are against a backdrop of very low interest rates, and there's now huge government interest in interest rates remaining low. For you, the consumer, interest rates on the high street are at pretty much an all-time low. I just looked last week, 1, 3 and 5 year deposit rates. We can see the returns that we could expect to get on those accounts just at the moment. And if we look at those gross figures, we could summarize those as pretty paltry. These were best rates taken from your money. So, we're not talking about high street rates, which tend to be even worse. What we know is inflation continues to eat away at the spending power of money. If you're a taxpayer and you put your money in a savings account and you leave it there for a sustained period of time, the rate of interest you get net of tax will not compensate you for even for inflation. We also know that the forecasts for inflation are that it will increase over the course of the next few years. There's a number of reasons for that. Imported inflation through the likes of Brexit and the currency issues that we have. And I guess also where things are opening up again, there's a high chance that some of the things that we look to purchase, discretionary spend items, will increase in cost. We may well have experienced it already personally, as a number of items I've bought at home that would have been 20–25% more expensive than they would have been a year ago. So certainly the forecast for inflation is to increase. The rhetoric, at least, is that the government will try and keep interest rates low. They need to promote growth in the economy, and the level of debt is such that interest rates, there's going to be a lot of pressure on interest rates remaining low. So why would we consider planning our finances against that background? 39% of people don't feel confident when they're talking about their money. That's a significant percentage of the adult population. 11.5 million people have less than £100 in savings. So it's clear that finances are a challenge for people just at the moment. A long-running study by the International Longevity Centre found that only 17% of people saw an advisor between 2012 and 2014. Now, there's a little period of time ago, but the results were only published in 2017. And those results found that those people who did see an advisor during that period of time, or during the early 2000s, by the time they reached 2014, had significantly higher savings than those who didn't see an advisor. That includes the period where there was a financial crash. The 2008 financial crash, of course, decimated investments. Yet despite this, people who saw an advisor were in a financially better position come 2014. So why consider planning your finances? The results are eminently available. It results in a better outcome for your own savings position. So what does good financial planning look like? Well, the first step is to take a detailed look at a person's current circumstances. Quite often when an individual comes in, they'll say, look, I want to set up a new savings account. They see it as a very, very simple transaction. In reality, as David will allude to earlier on, some seemingly simple situations can lead to some potentially complicated planning opportunities, which, whilst complicated, could serve to give quite a significant improvement on someone's circumstances. So when we're looking at someone's existing arrangements, we'd look to examine their own personal assets, their current liabilities, living expenses, costs. There's no rocket science in there, but it is about getting a detailed look at what someone has got already in place. An issue that often arises is people suggest that they've had plans which may well have been lost. So a very good example is pensions. People get married, they move house. Pensions are never high up on someone's list of things to keep track of. They quite often, the information that comes through the door gets filed in the bottom drawer somewhere and forgotten about. They're not very exciting. Actually, lost pension plans are worth millions in this country, and on a regular basis we'll engage with individuals and we will suggest that they trace their old plans that they feel that they may have lost. Dealt with a client recently who suggested they worked for an employer many moons ago. They said, well, the pension was probably not worth a great deal, so there was no point in trying to find the information. Actually, when they went through the pension tracing service, and there's some websites that are listed there that you can use to find pensions or savings accounts. When this client went through the pension tracing service, they managed to find a pension that was worth not just thousands, but actually hundreds of thousands. It had a material impact on their retirement planning arrangements. So reviewing your current circumstances and actually doing an audit to make sure that you've got a good handle on what you've got in place is an incredibly valuable part of the process and very much the first stage. The next thing is to work out your priorities and goals. If I think about my own finances, well, yes, in the future, I'd like to retire. I'd like to be able to help my children onto the property ladder. I'd like to go away on holidays. There's a whole host of things that I would like to do, but actually understanding which of those is a priority for me is important, and actually writing it down and having an understanding of it allows us to put together a plan for our own finances. Goals will differ from people to people. There's no silver bullet. There's no one answer. And it's important to be realistic. If I've got £10,000 now and I want it to be worth £1 million, it's highly unlikely that I'm going to achieve that in the course of the next year. So a good professional will assist you in outlining what is a realistic goal or target to achieve over a certain time frame. So as financial advisors, what we would look at is, as a third step, is evaluating someone's existing plans, pension arrangements, savings accounts, whatever is already in place. And we would compare those to an individual's life circumstances, their values, tax rules and legislation, the current economic conditions, and an individual's thoughts on risk. There's always a trade-off. So I had a client recently that I was dealing with who was talking about mitigating inheritance tax. They were actually unmarried. So one of the suggestions we made was simply to get married. That would have been very good planning from a tax perspective, but it was against their values. They'd been together for some 30 years. They didn't see that they needed to get married. So they had to challenge themselves, which was more of a priority. And it will, again, differ from people to people. So I mentioned there investment risk, and it never ceases to amaze me when people come to see me as a client. They say, well, my ISA is not giving me very good returns. I don't think ISAs are very good, or my pension's not very good. Well, it's important to state that a pension or an ISA is just a set of tax law. It's a wrapper in which we can put an investment. The thing that will deliver the returns is the level of risk that we take with those investments. And the level of risk that we take can lead to a markedly different outcome. So on the right here of this chart, we've got something that takes a comparatively high risk, not crazy high risk. We're not talking about investing into some new startup company. And on the bottom, or on the left-hand side of the page, we've got something that takes far lower risk. It's to do with the different assets that make up those underlying investments. And it just looks at returns over the last 70 months. And we can say very quickly, just by looking at the chart, we'd really like the 30% plus return, but we've got to ask ourselves if we're prepared to accept those potential losses. A 25% loss, that would have happened last year at the beginning of the pandemic, in number may not sound too frightening to some people, but when we apply it to our own circumstances, it can have a different outcome. If I've got £100,000 invested and I achieve a 25% loss in a certain period of time, that's £25,000. It's a lot of money, and it might make us feel uncomfortable, nervous. And if it makes us feel so nervous that we change our investments or we cancel them, then that's bad for the long term. So what we're not saying here is that everyone should take a higher risk. What we are saying is that people should engage with the level of risk they take within their investments. It can absolutely lead to very significantly different outcomes. And those outcomes need to align with your goals and objectives. So having looked at how our money is invested, decided upon the level of risk that we might want to take, the next job in the planning process is really to try and understand how we can reduce the tax that we pay. That tax drag will reduce our investment returns. And the starting point that we'd have for many people in terms of reducing income tax liabilities is still pensions. People will still say to me they don't like pensions. They're actually very, very flexible now in how you can take your benefits once you reach pensionable age. The myth that, if they die, the insurance company get your money is now exactly that, a myth. It doesn't automatically happen. And yet we can derive some really valuable tax benefits. So this just looks at a contribution of £10,000 for a basic and a higher rate taxpayer. And we can see that if we were to make that sort of level of contribution, we would get tax relief. Basic rate would get 20% relief, £2,000. Higher rate would get 60% relief. So the net cost of that investment is either £8,000 or £6,000, depending upon your tax rate. So a really effective way of making savings. We get an immediate uplift in the value of your money, which is incredibly valuable when interest rates are so low. So ignoring investment returns, people often say to me, look, yeah, I get that tax relief up front, but I have to pay that tax when I take my money out. And of course, that's true, but we still get the benefit of a tax-free sum that we can take from a pension. So at the moment, we can take 25% of our pension when we get to retirement as a tax-free lump sum. So in my example here, I've used the same £10,000. I've ignored any investment growth, and I know that I can get £2,500 back as a tax-free lump sum. It would leave me with a residual fund of £7,500. And yes, if I take that residual fund out, I'm going to pay tax. If I remain a basic rate taxpayer, that residual fund, £7,500, would be taxed £1,500 when I take my money out, leaving me with a residual fund after tax of £6,000. If I add that to my tax-free lump sum that I've received, that pension is worth to me £8,500. So I'm looking at the basic rate tax side of things here, and what I can see is that a net cost of the investment at £8,000 will deliver me £8,500, or again £500, with no investment return at all, purely by using the tax system. No other investment is going to give us, no other vanilla investment is going to give us an uplift such as that through simple tax planning. Of course, if you're a higher rate taxpayer, those benefits are doubled and the pension option becomes even more appealing. So once we've used pensions, yes, people will look to use things like ISAs. The compound benefits of investing in an ISA can be seen in the chart here. This simply compares a £20,000 investment growing at 5% a year over 20 years, and assumes that the grey line is taxed at 40%, the investment returns are taxed at 40%, the blue line at 20%, and the red line being the ISA, which there's no income tax on our investment returns that we get from an ISA. And we can see the compound benefit of that is quite significant over the medium and longer term. So again, ISAs, very vanilla in their nature. Often people say, well, look, I can't get the very good returns on there. Actually, the compound benefits of using the ISA are very worthwhile. And if we tie it in with making sure that we get the right level of investment risk, we can really generate a substantial return over a period of time. Once we've used pensions, ISAs, which is our, if you like, our first port of call for sound tax planning, simple tax planning. The next thing is to consider investments that seek to take advantage of our capital gains tax allowance, CGT allowance. So the annual exemption, now frozen, that was courtesy of the budget, is £12,300, but the rates are considerably more attractive than income tax. Now, of course, in the budget, they were talking about increasing capital gains tax rates, but for now, we've got a state of execution and the CGT rates remain 10 or 20%, depending upon whether you're a basic or a higher rate taxpayer, or if you're selling a residential property, they are 18 or 28%. And if we start to look about the impact of using capital gains tax or investments that seek to take advantage of your capital gains tax allowance, we can see the benefit here in this example. So this just looks at an £80,000 investment that over 5 years grows to £100,000. If that £20,000 gain was taxed to income tax, and in my example, I've used a higher rate taxpayer, they would pay £8,000 in tax and have a net investment value of £92,000. If we can take advantage of the capital gains tax allowance, we can see that we get the whole exemption of £12,300 and we pay tax at a lower rate, and it leads to a far lower tax bill. So when we're looking at existing arrangements, we're looking at the level of risk someone's taking with their investment, and we're looking to see how the investments are structured to minimize the tax drag, and we're trying to overlay that with someone's personal circumstances. Once we've done that, it's very much about implementing a financial plan. So goals when we're implementing a plan should be listed in order. David will talk about later the fact that we can have competing objectives, and it really is important to understand which of those is a priority to you. The last leg, the fifth part of the process, as it were, is really to reevaluate or revisit your plan that you've put in place. Again, so many people see it as a one-stop shop. I've done it, I don't need to look at it again. Whereas in reality, and really highlighting out of the budget and what's going to come over the course of the next few years, legislation will continue to change. Your personal circumstances will change, job changes, marriage, death, divorce, all of those things will change personal circumstances, and reviewing your plan against those circumstances on a regular basis is so important to make sure it's on track to reach your financial goals. Some examples of recent legislation change, and yes, just going to touch on the budget. Well, with pensions, as just an example, in 2020, the budget at the time announced a change about the maximum that a high earner could put into a pension. Historically, that was as high as 40,000. With the introduction of various allowances and restrictions, that's been reduced down over time. And in some instances, the 2020 budget brought in the fact that high earners can be limited to just £4,000 worth of pension contribution. If you're on a high paid job on a PAYE basis, it may be that your employer is paying in more than £4,000 for you, and you could be creating a tax liability and not knowing about it. It might be that that's just something you have to accept, but having a plan for it and understanding it is really, really useful. The 2021 budget, so the budget at the beginning of March, introduced further changes to pension legislation. There was a freeze on the lifetime allowance. The lifetime allowance is the maximum you can draw from a pension through lump sum or income without suffering onerous tax charges. The effective lifetime allowance tax charge is 55%, so certainly one to avoid. And where this lifetime allowance, which was previously going up with inflation, has frozen, it means that savers need to start thinking about this ahead of time. There's no point waiting till you reach that problem. It's trying to understand when you're going to reach that problem. So an example of this is someone who might currently have an £800,000 pension pot. It's a lot of money, but built up through a number of different employments, self-employment, company contributions. There's a good number of clients that can reach this sort of level. Where we get an investment return on that 800,000 over a period of time, and where we're adding to it. So in this example, I've added £1,000 on a monthly basis and assumed an investment return of 4.5%. We can see that by the time 2026 comes along, which is when the restrictions or the freezing of the lifetime allowance stops, that pension pot would have reached that target. So understanding that now and planning your finances, it may be that you would choose to have lower risk investments that have less chance of giving you that 4.5% return held within your pension, whereas your higher risk investments would sit outside of your pension, rather than the other way around. We might see people who've got higher risk assets in their pension and they could get a return that's much more than 4.5%, and all that's going to do is bring about the notion of this lifetime allowance problem much earlier. So having an understanding of the legislation, how it's going to be changing moving forward, can really impact on decisions that you make today. So why don't people do this? Well, they don't know where to look. That could be one thing. There's lots of information out there. In fact, there's a dearth of information now with the internet, and we could spend all day reading, trying to find the answer to certain questions. We'll always find certain or different answers for different circumstances. People find it complicated. A big problem is that people want quick results. We live in a modern society where quick results are common. I ordered some grass seed on Sunday night. That's a silly example. It arrived with me Monday morning. It's phenomenal what can get delivered in such a short period of time. And we, as a nation, we might overlay that to our own finances. Sadly, it's not the case. Quick fixes don't exist in financial planning. It is about working on something over a sustained period of time. Lots of people just want someone to tell them what to do. They try and look themselves, but actually they just want the comfort of having a regulated professional tell them what to do. Some people think it's not affordable. Financial services in general, professional services in general, can be quite expensive, but the value you get from it over time is quite significant. Another problem is people can't see past the short term. So again, people would easily be able to predict what might happen in their life over the next year or so. They might be planning to get married. There's some big event that's about to happen, but it's far, far more difficult to visualize what will happen in 20 or 30 years' time. And so creating a plan for that period of time becomes a real challenge. But actually, about when you start to visualize what will happen in the future, what you want to happen from a financial point of view, we can work backwards from there and we can create a plan. And lastly, I guess people don't trust financial institutions. So the 2008 financial crash really magnified people's views of that. But in general, through things like the media, people having bad experiences, it's a minefield out there, and people don't trust it. So they tend to avoid it, which is a shame, because actually what we know is delaying taking a plan really adds to the problems that you might be creating for yourself. So this just looks at the benefits of saving over a sustained period of time, or even early, rather than leaving it too late. So the red line here looks at a dedicated saver. It suggests that they make a £5,000 a year savings. They do that for 40 years. Over those 40 years, they would have saved £200,000. It's a lot of money. And it assumes that they receive an investment return of 4.5%. We can see at the end of that 40-year period of time, they would have built a pot of £559,000. So it's grown nicely, but the compound benefits have really worked in their favour. The next line is really the early saver. So this is someone who saves £5,000 on an annual basis for 10 years between the age of 25 and 35. They'd have saved just £50,000, yet by the time they reach age 65, that £50,000 has grown in value to £240,000, again, assuming a 4.5% return. Now, the striking point here is if you compare that to a late saver. So a late saver is someone who leaves it to age 40 to start saving, at which point they then start saving £5,000 on an annual basis, and they do that for 25 years. So they would have saved £125,000. So more than double what the early saver has put away, yet their savings pot is still valued at less, using the same 4.5% return. In this example, £232,000. Now, it might be the case that many 25-year-olds don't have the capacity to be able to make £5,000 annual savings, but it might be the case that as parents or as grandparents, we're in a position to help the younger generations out, and we can start to see where thinking about helping out the family generations can have a real benefit. Planning early has significant benefit. Planning and looking at things on an ongoing basis really serves to provide a better outcome over the longer period of time. So I think that's probably all from me just for the time being. As I say, if there's any questions, there will be the chat box at the bottom, and we'll answer those at the end. But for now, I'm going to hand over to my colleague David, who's going to talk through some perhaps particular tax tips or key principles that you and or your families can use to help mitigate tax implications.
Terrific. Thanks, Roy. Welcome, everybody. I'm going to share with you some insights and some ideas to help you with your tax planning in 21, 22 and possibly beyond. I've got some examples of the sort of work we're doing for clients at the moment and the sort of clients that we're doing it for, and I'm hoping that that can signpost you to the right sort of action to take in 21, 22, and also some guiding principles that I think can help you, whatever your circumstances, optimize your tax position. And of course, you wouldn't have escaped your knowledge that we did have a budget on the 3rd of March. And whenever we have a budget as accountants, we're focused on that screen to tell us, will the ground shift beneath our feet? Will we change any of the fundamentals that we're operating under at the moment that we're advising clients on? And we're very pleased to say, well, I was personally very pleased to say that the ground didn't move for us as far as the budget was concerned. As Roy said, there was some possibilities of changes to things like capital gains tax, possibly even inheritance tax, but there was nothing to alter the fundamentals that we're operating on today. Yes, some allowances have been frozen. There'll be an increase in corporation tax in 2 years' time, potentially. There's an SDLT holiday extension. All those things will affect us. But as far as tax planning is concerned, all the things that we should be considering are still there, pre-budget and post-budget. Of course, we are now in a new tax year. Happy new tax year to all of you. Next slide, please, Rach. So if we are where we were, where are we? Well, what we have is a very, very complicated tax system. And it's complicated because rather than wiping the slate clean every tax year and having a new set of reliefs and allowances, the fashion is to add new reliefs and allowances, and then to add new restrictions to those reliefs and allowances, and to add slightly more, ever increasing numbers of tweaks for how profits for different types of income are determined. And when you slice through all of those particular layers, you actually have a very complicated tax system, and it's actually increasingly difficult to identify what your tax position is, and before you even begin to think, well, how can I make an improvement to all of that? If I take John, for example, John's just a full-time working guy. He's got a good salary, but the reason that John's position is complicated, firstly, is because he has a bonus, and the bonus amount might vary. So John might not start the tax year knowing what his total taxable income will be. Recent-ish changes to the tax legislation mean that John will have to repay child benefit that perhaps his wife receives via his tax return. If his income goes above £100,000, his personal tax allowance is withdrawn. John's got a car there. If he changes his car, that can have an impact on what his total income will be. John, I expect, was received a tax code in advance of 21-22. HMRC habitually won't review that code for you, even if you begin to earn at a rate that's more than 100,000. So it's incumbent upon John to make sure he's got the right tax code. If he doesn't, at the end of the tax year, 10 months later, he could find that he's got a significant tax liability to pay to HMRC through self-assessment. And if John has all of his tax allowance in his code, but it's withdrawn in full, and he's got to come up with the child benefit that his wife has received, then John could find that he's got a £6,000 or £7,000 tax liability in January of 2023. And if your basic income is 80,000, that's a very significant tax liability for him to manage. The reverse could have happened as well in this period. In a pandemic, has John been furloughed? Has John taken a reduction in pay or bonuses? Has he taken a wise move of handing the car back to his employer if he can, to say, well, I'm actually locked at home, I can't really make use of the car? Has his employer got some salary sacrifice opportunities to make pension contributions? If John is coming off a very high tax period a very high income period where his taxes are higher, is John in a position where actually in 21-22 or 22-23 he is actually due a refund of those sorts of sums? So there's a big swing in the outcomes for someone like John, whose circumstances appear on the face of it to be quite straightforward. Now, if John, next slide please, Rach, if John has the temerity to do something else alongside work for a living, if he's inheriting a property or part of a property, or goes and buys a buy-to-let property, he's got to deal with all the issues related to that particular investment, and he has to revisit all of the judgments that he might well have made in evaluating his circumstances as they stood before. So he's got to worry about how profits are determined for rental purposes. Some of you will be aware that loan interest is no longer given as a deduction in calculating your total income for tax purposes. And therefore, what John's profit might be, his cash profit might be, is very, very different to what his taxable profit might be. So if John's balancing that with all of these other issues, the position is increasingly more complicated. John is married. So you might well think to yourself, well, can John, unlike his income, which is really his, the passive income that he has through his property investment, could that be shared with his wife, for example? That probably would make sense. But in circumstances where John's wife is a high earner, for example, thinking about a client the other day who's got a property investment, and his wife is a doctor and has an NHS pension. If we add income to her position, actually that does all sorts of difficult things for her in terms of tax relief on the pension savings that the government is making for her. So it becomes increasingly difficult to offer even the best, to offer the best advice to clients without getting a full understanding of all of their circumstances, simply because there are so many rates and release and allowances and restrictions to those allowances. And obviously, John is a high earner, but there are other categories of individuals, property investors and those who of a certain age who have funds to invest, where there is a significant amount of complexity. Now, Anthony Davies, one of our tax partners, will say, well, David, why isn't there a big oval there for non-residents and non-domiciled? And actually there could be, but their position is complicated, and it's often known by them and us that is a complicated position. There can be, other ovals which will have, a lot of complexity in them. But if you're a high earner or a property investor, or you're retired, or you might be in 2 or even 3 of those particular categories, there is a significant amount of complexity in the system. And I think it would be hard pressed for us to come across the circumstances where somebody who meets all 3 and there isn't some sort of efficiency that can be made in their financial affairs. Tax planning needs to be considered not just for the individual, but for their wider family, and possibly even for generations of family. So if you have multiple people in multiple categories here, actually the number of options that you have available is very, very significant. And actually just doing the housekeeping, the review of your circumstances on an annual basis to optimize the position has actually never been more difficult to do. So the key principles, whatever your circumstances, are that there are a lot of allowances and a lot of release, and you need to review those allowances and make sure that you're making use of them, that your family's making use of them. And there's a link there, I think, to all the allowances that are available. But on an annual basis, are you making use of all of those allowances? And if not, is there a mechanism for you to do so? And the other point here is around teamwork. Can you work not just with your significant other in your household, but children, grandparents, great-grandparents, brothers and sisters? I don't know how big your circle is, but if you can work as a team, can one person charge you for something? Can you charge them for something? Can you move assets to them or back to you? Do you give them something today or tomorrow or next year or when you die? How does all these are all the options that you have to consider. But if you can look beyond just your position and work as a team, you can actually optimize the position in a lot of cases. So these are some examples of what I'm calling here basic housekeeping. So these are not advanced planning techniques. These are not in any way controversial or going to fall foul of HMRC in any respect. But actually they become more and more complicated because the tax system requires it. So, if I have an investment company which has been funded by a loan from the investor, he's married, his wife has an income, but she's recently retired. So her taxable income is below £17,000, and the company can give her some of the loan and pay her £5,000 interest on that loan. And that interest is tax-free and tax deductible as far as the company is concerned. I had a client call up recently to say that he wants to make a pension contribution, which is great. And should he pay personally or should he pay from his limited company? A very reasonable question. And what is not obvious from the initial discussion, and is only obvious when you plough further into the circumstances, is that the optimized position for him and his family is not for him or the company to make that contribution, but for the company to repay him a loan that it owes him, and for him to give the cash to his wife, and for his wife to make a pension contribution, because her taxable income in that case is 60,000. And so we find that she gets higher rate relief for it, as well as not having to repay £1,700 of child benefit. So she actually gets 57% tax relief. Now, clearly that's a welcome return from that conversation. But actually, and as Roy was saying earlier on, the compound effect of these sorts of decisions, over a generation, we're talking 6-figure sum differences for people whose circumstances on the face of it don't appear to be deeply complicated. And number 4 there, actually go back, Rach, sorry. Number 4, talk about working as a family. I speak to a grandmother who wants to leave her grandson £25,000 in her will. Of course, she's perfectly entitled to do that, but of course the gift is going to be subject to inheritance tax. If she was open to making a gift now to her high-earning grandson, who's actually, because he's also a client, we know that he would otherwise be in a 60% marginal rate of tax, then actually, we can have a 60% tax relief for that money gifted now. So by working as a team, that you can have significant improvements in your tax outcomes. But the point here around housekeeping is it's never been harder to find what the optimized position is. So this is a sort of, I suppose, an overview, a sort of a summary, maybe a checklist, if you like, of the sorts of things that you should be considering. Roy's touched on pensions, huge tax relief for pensions. That's got to be a go-to option. For those people who are investing in new businesses, we've got to look at whether there's an EIS or CDIS solution, as well as ISAs. And of course, we have this category that we're terming housekeeping, but it's never been more complicated to try to optimize given the tax system that we have. Now, there are some other structures that we are considering for our clients. Certainly, what we're looking to do is exhaust the value of pensions and EIS and ISAs and our housekeeping beforehand. But I just want to touch on some of those structures. What's important to understand is that each of these structures has a different profile in terms of your ability to control what is happening and your ability to benefit and enjoy the income and the capital. So whilst these are thought of sometimes as far as tax planning devices, there are a lot of other important aspects to these things to consider. And if we start off with our family trust, for example, primarily, the most common trust that we're setting up for our clients is a trust formed by grandparents, where we're transferring up to £650,000 worth of assets to a trust. And actually, grandparents, I find, are, yes, they're concerned with tax, but actually what they're often concerned about far more is the protection of their children and their grandchildren from things like divorce, from insolvency. And so a trust provides a really, really satisfactory outcome in a lot of cases, because it provides the investors with control. It moves those assets outside of their estate for IHT purposes. And if the income is distributed on an annual basis, the effective tax rate is the tax paid by those individuals. And in some cases, those individuals can be young children. By far the most common arrangement that we will see is grandparents setting up trusts, but distributing income on an annual basis to children or the parents of children to cover school fees or other costs in their lives. And actually, we're able to use then the tax allowances of the children who, whilst they're young, won't have, other income, generally speaking. So trust is something is overlooked, but is really an important port of call. What's important here, of course, with a trust, unlike some of the later structures that we'll touch on, is that typically you are excluded from benefiting from that trust. So there's an important consideration here around affordability. We can give it away, but we can't get it back in a lot of cases. So this is good planning. But as Roy was saying, we've got to have a view of all of your circumstances to say, well, is it something that we can afford? We can't be putting large sums into a trust too early in your life, particularly if people are, on the whole, living a bit longer. So the next one is a company. And I guess we've seen a rise of what you'll sometimes term the FIC, so the family investment company. And primarily the rise has been because of big differences in the tax rates for investment income between individuals and companies. And you can see, the sort of relative, the rates of tax for certain types of income that apply to higher rate payers as well as to companies. And particularly, you can see there the 0% rate on dividends as compared to a 38% rate payable by individuals. Obviously, it's an arrangement which only going to reward savers. If the company has the income and it pays it out to you, then you're going to pay tax on it. But there's certainly seen a rise in the use of FICs. Also the company, the investor is also the director of the company. The company is able to meet reasonable remuneration and expenses and things like pension contributions, as noted on that slide. So yes, there's been a budget where they've signposted an increase to 25%, for some businesses. But there's still a huge disparity between the tax rates paid by individuals and companies. So we don't see any reason that will, not be of use to plenty of people over the coming years. Partnerships. So FICs have been well established for a while. I think what we seen more of in recent times is actually the use of the FIP, so the Family Investment Partnership. And actually what we found is that we've seen these used in a lot of cases of property investment. So if we think about our trust, for example, they are giving away those assets and the income permanently. And for some people of a certain age, they're concerned about inheritance tax, but they would like to have some benefit of the income and the capital, whilst looking to achieve some inheritance tax savings. So actually the Family Investment Partnership is something that we're seeing more of at the moment. So something that can well be worth considering. So we've got something called we're calling our hybrid, I suppose, but really hybrid is just the name given to arrangements which involve a combination of partnerships and companies or family trusts. So we might well have a trust as a shareholder of a company, or a trust as a member of our limited liability partnership, or a partner in our partnership. Lots of cases of partnerships which own the shares in investment companies, for example. So there are a number of different combinations that provide different outcomes, both legally and from a benefit enjoyment perspective. And of course, all of these have a very different tax profile, which need to be considered, before you look to adopt some of these things. But I think what we found as well, that actually the right structure for you actually might change over time, depending on the income and gains profile of the assets that you're holding. And this is just, I say, an example, and there are many different variations of a set of circumstances. And here it's the father who has a house with a large garden. He believes that he can section off part of that garden and apply for planning permission and eventually build some houses on it in that scenario. But what we've looked at and what we're doing for him is to establish a family partnership with our trust and our daughter, who's actually going to manage the bills, but actually to move in due course to our limited company, perhaps with father retiring at that stage. And because the father is the person who set up the trust, the daughter's not only able to distribute some income to her, perhaps and her spouse, up to a certain threshold, but income can be diverted into the trust for the benefit of the children and taxed at their rates. So, 3 children, husband and wife, actually that's £150,000, sorry, £250,000 of annual income that can be distributed at the 0% and 7.5% band, as a household, just by taking the right action up front. So, there's a myriad of possibilities that you might want to consider. And I think that's it as far as that's concerned, Roy.
Forgive me, you'd think after a year I'd have learned to unmute myself in that situation. But thank you very much, David. I really appreciate you taking the time to go through. There's some insightful tips. If we were to summarize it all, there's potential, huge potential when you start looking at things as a family, understanding all the detail that sits in the background regarding someone's financial affairs really helps create a sensible plan. And between tax advice that you might be able to provide, and if you like, financial planning advice, which helps understand those goals, we can really seek to get some pretty powerful outcomes for people. So, David, I know that there's a couple of questions that have come in. The first one is in relation to, there's one here about the state pension, private pension, referencing the potential changes to private pension age. So I think that one's for me. We have a situation where state pension is currently or has moved up to age 67. Forgive me, it's the state pension age has moved up to age 67. And then what will happen now is that private pension age is moving from age 55 up to age 57. That change is going to be taking place from 2028. And the expectation is that it will be phased in some way. There's currently a consultation around that position, and we will hear more in due course. But that is something that's changing. So if you're planning on stopping at age 55, absolutely this is an issue that you'll need to think about, because if you put all your savings into a pension with the view that you're going to retire at 55, and you might be, let's say, in your mid-40s, you're going to have to find a way to bridge yourself from 55 to 57, because the earliest you'll be able to get your money from your private pension will be age 57. David, I think there's a question there for you as well.
Yeah, I think Arthur's asking about property investments and some of the structures that we've just talked about. The question here is whether properties can be moved into a company. And of course, the answer to that is yes, they can certainly be moved into a limited company. Of course, if you're not starting with a blank sheet of paper in terms of your structuring, then we have to contend with things like capital gains tax and SDLT, stamp duty land tax, in terms of moving property assets into a company. But for property investors who are organised as a business, there's something called incorporation relief, which is available. And if you are in a partnership, for example, with your spouse, then actually there is a SDLT exemption for the transfer. So there's certainly a lot of people for income tax reasons looking at whether they can move property assets into a limited company. And there's a mechanism of doing that tax-free, but it's something that would have to be looked at in each individual case. But there's a lot of people doing that successfully without CGT and without SDLT. So the answer to the question is it is possible, and in some cases it can be done tax efficiently.
Thanks, David. I've got a further question here, which is, apart from waiting 5 years and looking back, how can we gain confidence in how much drawdown a person can afford each year? I assume we might mean from our pension or from our retirement plans, dare I say. We don't actually need a pension to retire. We just need sufficient assets to be able to sustain us. And I guess we mean, or the question's centered on the basis of how much can I draw now without risk of running out at a later point. And I guess ultimately there is no silver bullet. We might start by suggesting that you might take a view that you could take somewhere around 4% from the value of your assets, and that with some decent investment returns, those assets should sustain you through life. But much depends on what happens with inflation, much depends on what happens with investment returns. So this comes back to the point that there is no silver bullet that you can say, well, I can take that and then live 30 years without worrying about it. It is something that needs reviewing on an ongoing basis. So if you are looking at drawing from your investments, understanding the value of them and the level of income you need, and reviewing, having a checks and balances on a regular basis is really important. But a starting point for assumptions might be that a reasonable investment might give you somewhere around a 4% return. That will sound low. That's because it correlates to interest rates. So interest rates are basically nothing. So if we look at rental yields on rental properties, investment returns from stocks and shares, dividends from various different investments, that's just a reasonable summary, that 4% rule. So not accurate, but a good guide at least. So I think the final point there is someone has asked whether there will be a recording available. Yes, we'll download the recording, put it on our website, and you'll be able to get it from there. That probably leaves me just to say thank you very much for taking the time to attend our webinar. Still interesting and challenging to put these things on virtually. So I hope you've gained some benefit from it. And if you get questions that come up away from today, please host them to www.carpenterbox.com. Thanks very much.